This is a special edition of Macro Voices with hedge fund manager Eric Townsend, the premier financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. Now, for this special edition of Macro Voices, here's hedge fund manager Eric Townsend.
Macro Voices All-Stars Episode 70 was recorded on October 14th, 2019. I'm Eric Townsend. Forest for the Trees founder Luke Gromen is back with us this week. Luke, what's caught your attention recently?
Hey, Eric. Thanks for having me back on. You know, what caught my attention? Have you ever seen the Harrison Ford movie, The Fugitive?
Harrison Ford and Tommy Lee Jones, classic movie.
Oh, good. So then you'll know that in this movie, there's a great scene where Harrison Ford, who's desperately trying to find out who actually killed his wife, and hopefully I'm not giving away any spoilers here, but Harrison Ford's character finds some incriminating pictures tying some other characters to the crime, and so he calls U.S. Marshal Samuel Gerard, who, as you noted, played brilliantly by Tommy Lee Jones, and Harrison Ford's character says, "Do you remember what I told you in the tunnel?" And Tommy Lee Jones' character says, "I don't care. I'm not trying to solve a puzzle here." And Harrison Ford's character says, "Well, I am trying to solve a puzzle here, and I just found a very big piece." And so the reason I bring this up by way of background is because when we last spoke 2 weeks ago, we spent a lot of time talking about narrative failures. And last week, to our eyes, it appears a very big narrative failed.
Okay, how so? Which narrative and how did it fail?
So, the underpinning the bullish narrative on the dollar is a view that the dollar shortage plaguing the world will affect everywhere else first. And then after it's hit the entire world and the dollar's trading at some extremely high level, then the dollar shortage will hit the U.S. And now, as you know, I've never agreed with that narrative, repeatedly noting on Macro Voices and elsewhere that no one's more short dollars than the U.S. and especially the U.S. government. And so given the reality that A, no one was more short dollars than the U.S. government, and B, historically, no government with a purely fiat currency ever shuts down for lack of printing said fiat currency, our view was that well before the dollar rose too far, so to speak, it would hurt U.S. government finances to the point that the Fed would be forced to begin injecting new supplies of dollars to help finance those government deficits of the U.S. And on Friday of last week, the Fed announced it would begin doing exactly that.
Now, I'm sure almost all of our listeners know exactly what you're talking about, but just to be sure, the Fed announced last week that it would begin buying $60 billion per month of U.S. Treasuries, effective immediately, and also that it would continue its repo programs well into 2020. Curiously, they described this quantitative addition of assets to their balance sheet for the purpose of monetary easing as not being quantitative easing, even though that's kind of what it is.
That's exactly right. And, fascinatingly to me, Dallas Fed Chair Kaplan came out late Friday afternoon. He flat out said that Treasury issuance was the reason the Fed was being forced into this. And let me read what he said on Friday afternoon. "The big change in need for reserves is dramatic increase in Treasury issuance that takes liquidity out of the system. Banks are also holding more reserves because of capital requirements." And, we've been saying the Fed would be forced into this position, and on Friday they were forced into it, and Kaplan admitted it. And the narrative of the Fed's response to the repo spike, it's just temporary, it's just technical, that failed as well in our view. And so in our view, this sets up some really interesting opportunities for investors to position.
Well, Luke, to your credit, you definitely have been on record on this program of predicting exactly what was said, which is that Treasury issuance was going to be the problem that broke the camel's back. But what opportunities specifically are we talking about for investors now?
So, when firmly held narratives fail, unless you really fail by virtue of an absolute, call it, punch in the face type of piece of evidence, like the examples we used a couple weeks ago of when nuclear bombs were dropped on Hiroshima and Nagasaki in World War II, the human psyche tends to need to shift from one narrative to another by matter of degrees. And the narrative of, the Fed's going to let the dollar strengthen and let the world twist in the wind and the U.S. will be the last one impacted by this, that narrative just failed. So purveyors of the now failed narrative have begun to shift their narrative as well.
Okay, shift to what?
To some version of, yes, the Fed's now supplying liquidity, but it's not enough relative to what's needed. So Friday's announcement of $60 billion per month in Treasury and T-bill purchases is not a game changer.
And you disagree with that view, obviously.
Well, yes and no. Mechanically, no. Though they're right. The $60 billion a month probably isn't enough yet. But from a behavioral and from an indicator standpoint, what happened on Friday absolutely is a game changer in our view.
Okay, how and why is it a game changer?
If we take a step back and look to see the forest for the trees, the Fed just admitted that the U.S. government has a $720 billion annual dollar shortage. If we take the $60 billion a month multiplied times 12, and a $720 billion annual dollar shortage that had gotten so severe that the Fed would have to start buying $60 billion a month of T-bills ASAP. And in investing, it's all about what happens on the margin. And so on the margin, we've gone from no Fed liquidity to $60 billion a month, plus the extension of the repo programs. And more importantly, in our eyes, we've got the Fed admitting that the U.S. government's dollar shortage was a clear and present threat to the economy, for which for dollar bulls, were very rightfully so focused on sort of the path of who breaks first. This is a huge non sequitur. So, furthermore, do we really think that the Fed just did all of this to alleviate a dollar shortage in the domestic markets, but that they're not going to up the $60 billion per month to $80 billion or $100 billion or $120 billion per month when it's needed? And we think that they'll do what they have to do. We think Friday was a whatever it takes moment. So in under 4 weeks' time, we went from dollar shortage is critical, buy dollars, to Fed is doing massive overnight and term repos, extending them well into 2020, has begun buying $60 billion a month in T-bills. And, in that time, the Dixie, or the dollar index, went from 98 and change to 99 and change, and it's like right back to 98 and change.
So you think the Fed will simply keep increasing the amounts if they need to in order to keep up with the Treasury issuance?
I don't think they have a choice, Eric. So much of gross Treasury issuance is being done in the T-bill markets. And the reason they're being done in T-bill markets is there's not enough demand at the long end of the curve from either the foreign official or private sector. And so what you've seen is that the majority of Treasury issuance, 2 years and greater, has been bought by U.S. individuals. And this is the first time that's happened really ever, per the Wall Street Journal a few months ago. And so as a result, the majority of gross Treasury issuance is being done in T-bill markets. So if the Fed does not supply whatever liquidity to T-bill markets that's needed ad infinitum, we'll see the repo rates spike again until they do. And conveniently, we already know that the Fed responds to repo rate spikes in under 24 hours. So to me, the dollar super spike narrative likely just failed. It likely just got taken off the table. And I mean, there's still a dollar shortage. And if you have a small amount of capital, you can probably trade it. But if you're running a big book, the Fed just told the world it'll cap any and all dollar rallies because so much of the U.S. government's financing is being done at the short end of the curve. And so failure by the Fed to supply the needed liquidity to finance those deficits at the short end of the curve will spike repo rates, which, if left untouched for a brief period of time, creates a whole slew of problems for the U.S. economy and for the global economy.
Are there other ways that this could be dealt with besides the Fed just buying all of the U.S. Treasury's T-bill issuance?
Yeah, sure. The regulatory balance sheet constraints that are helping to force this, Basel III and Dodd-Frank regulations could be removed, or you could just have the dollar weaken meaningfully some other way, and that would restore foreign private sector bid for treasuries on an FX hedge basis back to full strength by normalizing FX hedging costs for the dollar. But importantly, either one of these are really just applications of dollar liquidity by another name that point to the same outcome, which is the failure of the narrative of a dollar super spike driven by unresolved dollar shortages, because ultimately the domestic dollar shortage got too acute too fast, which is really what we thought would happen.
So why do you think that the narrative is shifting so slowly, and why do you think that this sets up opportunities for investors?
I think it's shifting slowly from the Fed side for one of two reasons. If you shift it too fast, you can cause more problems in terms of policy than it solves. You go slowly, it allows markets to adjust in a more orderly fashion. If I wanted to be cynical, I could say it's easier to boil a frog slowly because he's less inclined to jump out of the pot. But either way, it sets up a dynamic for investors where he who moves first moves best. The dollar super spike narrative likely just failed. The Fed just began effectively financing U.S. government deficits for what's likely to prove an extended period of time or until the dollar falls sharply. And like we said before, the biggest marginal buyer of 2-year plus treasuries are U.S. individual investors who, unfortunately have been the proverbial, call them suckers at the table in both of the last two bubbles, both the tech bubble and the housing bubble. And now, with rates at 5,000-year lows, the biggest marginal buyer at the long end of the Treasury curve.
So what are the opportunities that sets up for investors?
So, we've done extensive work over the last several years that due to poor policy choices made over the past 25 years in both domestic economic policy and foreign policy, for that matter, the U.S. stock market is now effectively the U.S. economy. And given U.S. federal debt levels and a dearth of foreign buying in treasuries since the third quarter of 2014, the corollary to all of this is that unless the S&P 500 rises against the TLT, or long-dated U.S. Treasuries ETF, unless SPX rises over TLT versus TLT over time, the U.S. government will find itself in a fiscal crisis very quickly. And it's interesting. That's sort of been what our research pointed to. And you take a step back and say, well, since October of 2018, the S&P has fallen sharply versus the TLT. And here we are, barely 12 months later, and we're a long way from neutral, and we're going to raise rates 3 more times. Where we stood 12 months ago, and now the Fed's growing their balance sheet at an annual $720 billion rate of non-QE, as you noted before. Plus, they're engaged in significant repo programs that they just extended. So, to our eyes, as best we can tell, this dynamic remains poorly understood. And by that, I mean the S&P needs to rise versus TLT ad infinitum in order to keep the wheels on the cart. And so, our bet all along has been that the U.S. government will not let itself go out of business for lack of printed dollars. And that bet we think is about to start paying off, and it suggests being long S&P against the TLT, being long gold, silver, we think a little Bitcoin as well.
Luke, you mentioned in each of your last 2 interviews that you thought that if real interest rates rose a bit, that gold could sell off once the Fed was forced to begin expanding their balance sheet. It appears that began happening last week. So how long do you think that will continue?
It did happen, and I would tell you, in terms of our core position, we didn't touch our gold at all, only because we think the sell-off in gold is a great opportunity. Our view is that as more investors realize that what the Fed's been forced into, they'll see they'll see it as we see it, which is that what's likely now begun is a perfect positive storm for gold. So that's sort of how we're sitting right now.
Okay, Luke, I want to come back to your core view, though, because everything you're saying, I mean, on some levels, it makes perfect sense to me, which is you predicted exactly this, that Treasury issuance would be what would force the Fed's hand, and to some extent, that's what the Fed's own representatives have acknowledged on Friday. But I want to play devil's advocate, or maybe Jeff Snyder's advocate, as the case may be, and say, wait a minute, look at the price. We've seen Treasury yields collapse to half of the yield that they had a year ago. So whether that bid is coming from conventional sources or from individual investors, whatever, there's been a huge bid for Treasury paper. It's not like nobody's willing to buy it. So how can you say that the Fed's hand has been forced to buy up all of the new Treasury issuance when, from a price standpoint, I mean, certainly we've had this repo shock that maybe is a good explanation, but from a price standpoint, the prices are already super high. It seems like there's plenty of bid there.
Yeah, it's a great question. It's a $64,000 question, really, and I think you have to take a look at what was planned for Treasury auctions, and I think you have to take a look at who's buying where and where the U.S. government is issuing paper. And so 5 years ago, weighted average maturity for U.S. debt outstanding was, call it 68 months, a little over 68 months. And the plan at that point, per the Treasury Borrowing Advisory Committee, was to take that number up and to the right at a 45-degree angle, for the next 5 to 10 years. So that was 3Q14. Fast forward 5 years, in 3Q19, that same chart shows you that U.S. government weighted average maturity is actually flattened down a bit. Now, all of this has happened during the biggest bid for duration in 5,000 years, lowest rates in 5,000 years. So the question then becomes, why did the U.S. Treasury keep duration flat or shrink it when it planned on raising it rapidly, at a time when there was this inexorable bid for duration? And there's only 2 possible answers. Answer 1 is Treasury didn't know that there was a strong bid for duration. And of course, there's no way that that's true. Or answer number 2 is the demand for the long end of the curve is not what people think it is. And then we take a look of okay, why is that the case? And you can see very clearly, per our point earlier, that all the debt issued 2 years and beyond in the last year to date, over half of it's been bought by U.S. domestic investors. That number was less than a third 5 years ago. And so what you've seen is basically a pushing of long-dated U.S. Treasury paper onto the group of investors that are usually the suckers at the table, right? They're they were buying Sand State real estate in 05 and 06, and they were buying tech stocks in 99 and 2000. And guess what they're piling into now? They're piling into long-dated treasuries for safety. On the flip side, you've seen year-to-date U.S. Treasuries on pace to issue $11.3 trillion in gross issuance, and over half of that is done at 6 months or less. And so what all of this points to is that if you were going to see a mismatch in supply-demand, it would show up in the 6 month or less time. And what's happened in the last 12 months? You saw Fed funds go over IOER. You saw repo rates spike. And so, and you've seen the Fed now be forced to come in. Where's the Fed acting? Fed's buying T-bills. They're not buying long dated. So I would agree with Jeff. The long end of the curve is fine, and rates show that there's been strong demand. It's been from primarily, sort of the best contra indicators out there historically in terms of investor groups. And really where the supply-demand mismatch has manifested has been where the Fed's been forced to respond.
Luke, thanks so much for joining us today. We look forward to getting you back next month for another update. Listeners, be sure to stay tuned to your Macro Voices feed. We've still got Julian Brigden and Stephanie Pomboys coming up on our feature interview for Thursday's flagship podcast. For the Macro Voices Podcast Network, I'm Eric Townsend.
That concludes this edition of Macro Voices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. Please register your free account at macrovoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to Macro Voices on iTunes to have Macro Voices automatically delivered to your mobile device each week, free of charge. Macro Voices is presented for informational and entertainment purposes only. The information presented on Macro Voices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Macro Voices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. Macro Voices, its producers, sponsors, and hosts, Eric Townsend, shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on Macro Voices.